Most traders crash in their first year because they chase consistency in the wrong place. They think consistency means winning every trade. It doesn't. Real consistency is a system, not a streak. And that system starts with the 1-hour chart. Here's the brutal truth. 87% of retail traders fail because they trade too many time frames at once. They're checking 5-minute candles, then 15-minute, then hourly. Their brain never settles. Their conviction wavers. They cut winners early and hold losers too long. The 1-hour chart fixes this. It's the Goldilocks time frame. Fast enough for intraday action, slow enough to filter noise. It forces patience on an impatient mind. But here's what separates professionals from amateurs. Professionals trade the 1-hour chart with rules, not feelings. An amateur sees a setup and enters on hope. A professional sees the same setup and asks, "Does this fit my system?" Then they either take it or walk away, guilt-free. Consistency isn't about being right more often. It's about being disciplined more often. In the next few minutes, I'm going to show you the 5 non-negotiable steps professionals use to turn the 1-hour chart into a reliability machine. These aren't revolutionary. They're boring. But boring is profitable. By the end, you'll have a framework that removes emotion from your decision-making. You won't guess. You won't hope. You'll execute. The catch? You have to commit to it even when, especially when, the market rewards breaking the rules. That's where 93% of traders fail. They follow the system for 3 good trades, then abandon it on the 4th when they feel a move coming. We'll address that psychological snare later. For now, understand this. The 1-hour chart is your stage. Everything that happens here, every entry, every exit, every loss, teaches you about yourself as a trader. In either direction. A bot can trigger a flash move. A news release can cause a tick spike that means nothing for the 1-hour trend. On the 5-minute, you're trading ghosts. On the 1-hour, you're trading structure. Price has to prove itself over 60 minutes. It can't fake it. This is why professionals gravitate to the 1-hour. It's the minimum time frame where structure is real. Now, here's what most traders miss. The 1-hour chart doesn't just filter noise. It forces patience on a psychology that craves action. This is crucial. Trading, at its core, is a boredom problem masquerading as an analysis problem. Amateurs think they lack analysis skills. Usually, they lack patience. They want to trade something now, so they find a reason to enter. The 1-hour chart removes this temptation by making false signals obvious. If you're on the 1-hour, you're waiting for 1 signal every hour, maybe less. That's 8 potential trades in an 8-hour day. Most traders will only see 2 or 3 actual setups. The rest of the time, you're watching, learning, and, most importantly, doing nothing. Doing nothing is the hardest trade for amateurs. It feels like failure. It feels like leaving money on the table. But professionals know that the best trade is often the one you don't take. Jesse Livermore made a fortune sitting in his office waiting. He called it waiting as a position. The 1-hour chart enforces this. It teaches your brain that inaction is not a loss. It's discipline. The rules I'm about to share with you, the 5 steps, are only powerful if you commit to this foundation. 1 time frame, the 1-hour, and nothing else. No peeking at the 5-minute for confirmation. No checking the 4-hour for context. Just the 1-hour. This singular focus is what separates the traders who make money from the traders who talk about trading. The ones who talk about it are multi-time frame junkies. The ones who make M. Why? Because every winner was $80, and every loser was $150. Whipsawed by ghosts. His setup recognition was fine. His stop losses were tight. But the market structure during his trading window was against him. It's like playing poker against worse players, but at a table with antes so high that you can't win long term. The math was broken from the start. Then he shifted to London Open, 8 a.m. EST only. Same signals. Same system. Same discipline. Suddenly he's making $200 on winners and cutting losers at $60. His win rate didn't improve, it actually stayed around 52%, but his edge transformed. Why? Because during London Open, the USD is thick with institutional flow. Banks are trading, hedge funds are positioning, retail traders are piling in, the spread is tight, the volume is real. A 1-hour candle during London Open tells you something meaningful about where money is moving. A 1-hour candle at 6 a.m. EST tells you almost nothing. It's just noise bouncing around, waiting for the real market to open. This is the invisible killer that separates amateur traders from professionals, and most amateurs never figure it out. They think their system is broken when really their timing is broken. They're trying to trade quality setups in garbage market conditions. It's like a skilled archer trying to hit a target during an earthquake. The skill doesn't matter if the environment is hostile. The protocol is simple but non-negotiable. Track your chosen instrument's best liquidity window. For stock indices like the ES or NQ, that's NYSE Open, typically 9:30 a.m. to 11:30 a.m. EST. This is when volume explodes, when institutional money is active, when retail traders are also awake and present. For forex pairs, especially EUR/USD, that's the London overlap with New York, roughly 8 a.m. to 12 p.m. EST. This 4-hour window captures the transition from London session into New York session, and when two major financial centers overlap, liquidity deepens and false signals flatten out. For crypto, the situation is different. Liquidity is technically 24/7, so you don't have a natural window imposed by market hours. But your psychology does. You need to choose your sharpest mental window. Are you sharpest in the morning? Trade crypto from 8 a.m. to 12 p.m. your local time. Are you sharpest in the evening? Trade from 6 p.m. to 10 p.m. The instrument doesn't matter as much as the consistency of your attention and mental clarity. Write this down somewhere visible. I trade the 1 hour between your start time and your end time only. No exceptions. Laminate it if you have to. Post it above your monitor. Make it a mantra. This single rule cuts out 60% of weak signal noise and eliminates the always-on paralysis that kills amateur traders. Most amateurs think they need to be present for every move. They believe that if they're not watching, they're missing money. But every hour they're not trading is an hour they're not risking either. The professionals understand that capital preservation is just as important as capital growth. You're not trading all day. You're trading your window. During that window, you're sharp, focused, and ready. Outside that window, you're off. You're resting. You're not checking charts. You're not second-guessing. You're simply unavailable to the market. This behavioral discipline is what separates professional trading from amateur trading. An amateur trader is always on, phone buzzing with alerts, charts open on 3 monitors, checking positions every 5 minutes. This constant vigilance doesn't increase edge. It decreases it because it turns the trader into a nervous, reactive machine instead of a calm, deliberate decision maker. A professional trader has defined hours and defined instruments. Outside those hours and instruments, the market does, and exists to them. They've chosen their battlefield, and they're not going to be dragged into other battles. Let me give you another story to illustrate the cost of this mistake. I knew a trader, experienced guy, who traded GBP/USD on the 1 hour. His system worked. He had solid entry rules and good discipline. But he was trading across multiple sessions, London, New York, Tokyo. He'd catch a move at 6 a.m. EST, then stay glued to the chart at 2 p.m. EST just to see what happens, even though his 1-hour rule said to be done for the day. One afternoon, he saw a setup that felt right even though it wasn't in his defined window. He took it anyway. It felt right because his brain was tired and desperate to trade. Price moved against him. He held it through the stop because he was emotionally attached to this one trade. By the time he closed it, he'd lost $400 on a single trade, more than his entire daily target. The next day, he was gun-shy. He missed his real setup because he was still nursing the emotional wound from the off-window trade. The trader who shifted to a defined window, only 9:30 a.m. to 11:30 a.m. EST on the ES, actually made more money in less time. He traded maybe 2 or 3 setups per day during his window. Outside the window, he didn't look at charts. He didn't check alerts. He was offline. This forced rest meant that when his window opened the next day, he was fresh, mentally clear, and ready to execute with precision. His win rate stayed the same. His average winner grew. His consistency improved. Why? Because he wasn't fatigued. He wasn't emotionally worn out from fighting off-hours trades. He was simply executing the plan during his designated time. This is the hidden advantage that professionals have. They've engineered their trading life to match their biology and their market structure. They've answered the fundamental question, when and where do I trad? And they've locked that answer in place. An amateur is still figuring this out at trade number 347. A professional figured it out at trade number 3, and then executed the same plan for the next 500 trades. Now, here's where this connects back to the 1-hour chart and why it matters for the next step. Once you've defined your window, you need to know exactly what price action looks like when you're inside it. During your window, the market has certain characteristics. Volume is predictable. Volatility has a rhythm. Support and resistance levels are more reliable. This is the environment where you'll recognize your best setups. Outside your window, the same price patterns might look completely different. That's why step 2 is about recognizing the pivotal point, the specific type of price action that signals a real tradable setup within your window. The two concepts are inseparable. You can't recognize quality price action if you're not in a quality market environment. And you can't be in a quality market environment if you haven't defined your window. So before you move forward, commit to this right now. Write down your window. Say it out loud. Tell someone. Make it real. I trade the 1 hour between time and time only. This isn't limiting. This is liberating. You're taking back control of your trading life by choosing when you're available to the market rather than letting the market choose for you. That's professional behavior. That's the foundation for the next step. And that's the beginning of real consistency. Here's where most traders lose their minds. They see any bounce on the 1 hour and assume it's a trade setup. It isn't. Professionals filter for one type of bounce, the pivotal point. This is a price level where the market has hesitated, reversed, and shown structure. Not just touched and bounced. Structured hesitation. The difference between these two seems subtle on the surface, but it's the difference between a trader who loses $50,000 a year and a trader who makes $50,000 a year. Think of it this way. An amateur sees price drop, bounce, go up. Trade. A professional asks, where did price pause? What made it pause? Did it show reversal confirmation? 3 questions, 3 filters. That's the difference between emotion and discipline. The pivotal point is the professional's holy grail on the 1 hour chart. It's not an indicator. It's not a formula you can plug into your charting software. It's a pattern, a specific sequence of price behavior that tells you something meaningful has shifted. A pivotal point is where institutional money has decided to defend a price level. It's where the order book is clustered. It's where weakness has been absorbed and strength is beginning to build. But here's what trips up amateurs. They can't see it because they're looking for the wrong thing. They're looking for any bounce. Professionals are looking for structured bounces. Let me illustrate with a story from the 2024 volatility. I was mentoring a trader, let's call him David, who was trading the ES on the 1 hour. He had good discipline with his window, 9:30 a.m. to 11:30 a.m. EST, remember that. But he was taking every bounce. Price dropped from 4,200 to 4,165, then bounced to 4,180. He saw the bounce and entered long. Felt good in the moment. Price was moving up, momentum was positive, the setup felt right. But when I looked at the chart, I saw what he missed. The bounce was thin. The 1 hour candle that formed at 4,180 had no lower wick rejection, no volume spike into the support level. The candle was just a doji sitting on top of a vacuum. It was momentum, pure momentum, with zero structural support beneath it. So price continued lower. He got stopped out at 4,172. Lost $200. Frustrating but recoverable. 2 hours later, same sea. Xi'an, same market. Price dropped from 4,200 down to 4,155. Now here's the key difference. Price paused at 4,160. It didn't just touch and bounce. It consolidated for 3 full 1 2-hour candles. During those 3 candles, volume spiked. Real institutional volume, not retail panic. The candles showed lower wick rejection, meaning buyers were defending that level hard. By the 3rd candle, the body of the candle had moved up. The setup was structured. This was a pivotal point. David entered long at 4,165 on the 4th candle after the pattern was confirmed. Same move up as the first trade. Price rallied, but this time he held it for $420 profit because the setup had structure. The difference? Not his entry price, not his stop loss, not his position size. The difference was the quality of the setup. The first bounce was noise. The second bounce was a pivotal point. This is the lesson that separates traders who win 35% of their trades from traders who win 50% of their trades. It's not about being right more often. It's about taking setups that are actually setups and ignoring the ones that just look like setups. And to do that, you need a protocol. You need 3 filters that separate the signal from the noise. The protocol is straightforward, but requires discipline to execute. On your 1-hour chart, before you enter any trade, you must ask 3 questions. The first question, did price pause? Not just touch a level and bounce. Did price actually consolidate for at least 2 to 3 1-hour candles? If price drops, bounces once, and keeps going, that's not a pause, that's momentum. A pause is when price shows hesitation. It stalls out. It ranges sideways for a bit. This consolidation tells you that the market is deciding. Buyers and sellers are wrestling at a specific price level. That's where pivotal points form. The second question, does the candle show rejection? This is where most amateurs get confused. They think rejection means a big wick, but rejection comes in multiple forms. It can be a lower wick on a bullish setup, price dropped, but buyers came in and pushed it back up, creating a wick. Or it can be a body structure where the close is significantly higher than the low of the candle. Or it can be a volume spike at that level. Any of these patterns tells you that something rejected the lower price. Something said, no, we're not going lower. That something is institutional money. That's the signal. An amateur sees a bounce and enters. A professional sees a bounce with rejection and enters. The third question, is there directional confirmation? After the pivotal point forms, do the next 1 or 2 candles move in your intended direction? This is crucial because it means the pause is resolved. The wrestling match between buyers and sellers is finished, and the winner is walking away with the market. If you see a perfect pivotal point, but the next candle closes lower, that's not confirmation. That's the market saying false alarm. Wait for the next setup. If you see a perfect pivotal point, and the next candle closes higher with strong volume, that's confirmation. The buyers have won. Now you can enter with conviction. Here's where it gets subtle. If you answer yes to all 3 questions, that's tradable. Anything less, wait. This is where professionals and amateurs truly diverge. An amateur sees a beautiful pivotal point, but no directional confirmation, and he enters anyway because the setup looks good. A professional sees the same setup and thinks, the pattern is there, but the market hasn't confirmed the direction yet. I'll wait. And then he waits for the next candle, or the one after, until confirmation appears. Or he walks away because confirmation never comes, and the pivotal point was a trap. And here's the sneaky art that most traders never understand. Waiting is the trade. Doing nothing when the setup isn't clean is actually the highest conviction move a trader can make. This feels counterintuitive because trading culture celebrates action. More trades, more opportunity, more wins. But professionals know that the best trade is often the one you don't take. If you skip 10 mediocre setups and take 2 clean ones, you're ahead of the trader who took all 12 and got whipsawed on the 10 bad ones. Your win rate might be lower in raw numbers, but your edge is higher. Your average winner is bigger. Your average loser is smaller. The math compounds in your favor. Think about this. If you see 3 pivotal points in your trading window, and only 1 has full confirmation, you're filtering out 67% of potential trades. That sounds bad. But those 2 filtered out trades would have lost you money. The 1 clean trade makes up for both of them and still leaves you profitable. That's how professional traders think. They're not trying to maximize the number of trades. They're trying to maximize the quality of trades. Here's the psychological benefit that most people miss. When you commit to this 3-question protocol, you develop conviction. You enter fewer trades, but you enter them with absolute certainty. You're not guessing, you're not hoping. You've asked 3 questions, received 3 yes answers, and now you're executing. That conviction changes how you hold the trade. You don't panic at the first wick against you. You don't take profit early because you're afraid. You hold because you know the setup is solid. And that holding, that conviction, is what turns small winners into big winners. Amateurs don't have this conviction because they've entered on hope. Professionals have it because they've entered on structure. The difference in outcomes is dramatic. Over 100 trades, the professional trader's conviction-based holding turns mediocre setups into profitable ones. The amateur trader's hope-based cutting turns solid setups into break-even or losing ones. So from this moment forward, when you see a bounce on the 1-hour chart, don't ask, should I trade this? Ask, does this pass the 3-question test? If the answer is no, you know what to do, nothing. Wait, be patient. The pivotal point will come. And when it does, with all three confirmations, you'll enter with the conviction of a professional. Here's what kills traders faster than bad setups, good setups with bad position sizing. This is the invisible assassin in trading. A trader can have a perfect entry signal, perfect stop-loss placement, perfect exit discipline, and still blow up his account because he sized wrong. Conversely, a trader with a mediocre setup but disciplined position sizing will survive long enough to learn, adapt, and eventually win. The survivor wins the game. This is not theoretical. This is mathematical law. And it's the reason why 87% of retail traders fail, not because their analysis is bad, but because their sizing is reckless. Let me be clear about the hierarchy here. Professionals think about position size before they think about entry. They calculate it before they place the trade. Amateurs think about position size after they're in profit and starting to dream about yachts and early retirement. By then, it's too late. The damage is already baked into the position. An amateur enters a trade, it moves in his favor, and suddenly he's thinking, what if I had sized bigger? So on the next trade, he does. And that's when the market reverses and wipes him out. The position was already too large to survive the inevitable drawdown. The math is sobering, and I want you to sit with this number because it will change how you think about sizing forever. If you risk 2% per TRA on your account and you suffer a 10-trade losing streak, which is normal, not catastrophic, you've lost 18% of your account due to compound drawdown, not 20%. 18%. Why? Because each loss is calculated on the remaining balance, not the original balance. So after the first 2% loss, you're at 98% of your starting capital. Your next 2% loss is 2% of 98%, not 2% of 100%. By trade 10, you've eroded your account significantly. You're psychologically wounded. Your confidence is shattered. You're making desperate decisions with what's left. Now, same scenario at 1% risk per trade. Same 10-trade losing streak. You've lost 9.5% of your account. You're down, sure, but you're still standing. Your account still has 90.5% of its capital. Psychologically, you're in a completely different place. You can take the next trade with clarity instead of desperation. You can think about the market instead of thinking about your losses. And that clarity compounds. Over the next 20 trades, you'll make better decisions because your mind is clear, not poisoned by fear. This is why professionals size small, not because they lack conviction, because they have too much conviction in the market's ability to surprise them. Jesse Livermore understood this better than anyone in his era. He made and lost fortunes multiple times. And every time he rebuilt, he did it with small position sizes. He had a maxim: trade as if you're wrong. What he meant was, size your position as if this setup, despite all your analysis, despite all your conviction, might fail. Because it might. The market is the only honest thing in trading. It doesn't care about your analysis. It doesn't care about your conviction. It cares about flow. And flow can reverse instantly. So here's the protocol that professionals use, and it's simple enough that there's no excuse for not following it. For your 1-hour trades within your defined window, you will risk no more than 0.5% to 1% per trade on your total account. Not per week, not per month, per trade. This is the ceiling. You never go above it, regardless of how good the setup looks. The second rule, calculate your position size from your stop loss, not from your target. This is crucial. Most amateurs do it backward. They think, I want to make $200 on this trade, so I need to buy X contracts. Then they place the stop loss and hope it doesn't hit. Professionals think, my stop loss is 20 pips away, my account is $10,000 and I want to risk 1%, so I can risk $100 per trade. At 20 pips per $100, that's X contracts. The position size is derived from the stop loss, not the profit target. This removes guesswork. The formula is simple: account risk in dollars, stop loss distance in pips equal to position size. Let me walk through an example so it's crystal clear. You have a $10,000 account. You decide to risk 1% per trade, which means your maximum loss is $100 per trade. You're looking at an ES setup on the 1 hour. Your stop loss is 20 pips below your entry. So the math is $100 divided by 20 pips equals 5 micro contracts. That's your position size. On the ES, each micro contract is $1 per point. So 5 micros means you're risking $100 if price hits your stop. That's exactly 1% of your account. No more, no less. Now, here's what this protocol does. It removes the greed equation entirely. You can't oversize because the math won't allow it. An amateur looks at a sure thing setup and thinks I should size up on this one. But if he's following the formula, he physically can't. The formula says 20 pips away, $10,000 account, 1% risk equals 5 micros. That's it. There's no room for hot-headed decisions. There's no room for I feel this one sizing. The math is the boss. The math doesn't negotiate. But here's where the psychology gets interesting. Most amateurs skip this step entirely. They eyeball their position size. I'll take 10 contracts, they think, without doing the math. Then when they're up $500 on the trade, they think I wish I'd size bigger. So on the next trade, they do size bigger. They take 15 contracts. And that's when the market reverses on them. And they get stopped out for a $750 loss instead of a $500 loss. One bad decision ripples. One oversized position leads to the next one, until eventually they're blown up. Professionals size like the market might reverse tomorrow, because it might. They don't size based on confidence in the setup. They size based on respect for the market's power to surprise them. Mindset produces a specific behavior, discipline. You follow the formula every single time, regardless of how obvious the setup seems. You size small on the sure things because those are often the most dangerous. You size small on the mediocre setups because you're uncertain. You size small on everything because that's what professionals do. And here's the hidden payoff that most traders never discover. When you size small, your winners are still meaningful, and your losers don't scar you. You take a loss of $100, and sure, it stings, but it doesn't ruin your day. It doesn't ruin your week. You can take the next trade with a clear head. But if you'd sized at $750 per trade, that loss destroys your psychology. You're now thinking about that loss instead of thinking about the market. You're making angry decisions. You're revenge trading. You're trying to get the money back immediately instead of waiting for the next clean setup. Here's the compound effect over time. A trader with 1% risk sizing might have a string of 5 losing trades. That's $100. 5 equal to $500 in total losses, or 5% of his $10,000 account. It hurts, but it's manageable. He takes the 6th trade, it hits, he makes $180 after fees. He down $320 for the day. The next day he trades again. Within a week, he's recovered and is back to even or slightly positive. His account is intact. His psychology is intact. He's ready to grind. A trader with 5% risk sizing might have a string of 5 losing trades. That's $500 x 5, equal to $2,500 in total losses, or 25% of his $10,000 account. He's devastated. He's now thinking about quitting. He's desperate. On the 6th trade, he overtrades to try to get the money back. He loses again. He's down to $6,000. He's considering whether trading is even possible for him. He quits. Game over. Same 5 losing trades, same market conditions, different sizing, different outcome. One account survives and thrives, the other account dies. This is not luck. This is math. This is discipline. So here's what I need you to do. Calculate your 1% risk amount right now. If you have a $10,000 account, your 1% is $100. If you have a $5,000 account, your 1% is $50. Write that number down. Then, for every trade you take, calculate the position size using the formula before you enter. Make it a rule. Make it non-negotiable. Make it the first thing you do, even before you look at the entry signal. Because if you size wrong, the entry signal doesn't matter. You've already lost before you've even started. Most traders do the opposite of what works. They cut winners in half to lock profit. They hold losers hoping for a bounce. This is the signature tell of an amateur, and it costs them 40 to 60% of their annual returns. This isn't hyperbole. This is the difference between a trader who makes $30,000 a year and a trader who loses $15,000 a year. The behavior is simple to describe, brutal in its consequences, and shockingly common. A professional has a stop loss and hits it. No negotiation. No just one more candle. No, it'll bounce. The stop is law. When price touches it, the position is dead. Finish. Clean. There's no discussion, there's no hope, there's no emotional attachment. The trade is over. The next trade begins. Why does this matter so much? Because the moment you hold a loser, the moment you decide that this one trade deserves special treatment, you've entered negotiation mode with the market, and the market doesn't negotiate. But your brain does. Your brain starts telling you stories. It'll bounce back. I'll just wait 1 more hour. If I close now, I lose. If I wait, maybe I win. These stories are poison. They're not analysis, they're hope. And hope has no place in trading. The moment you hold that loser, your next 10 trades are infected by that emotional remnant. You're smaller on the next winner because you're still smarting from the loss you shouldn't have taken. You're more hesitant. You're less confident. You're second-guessing. One bad decision ripples through your entire trading psychology. Let me give you a real scenario that illustrates exactly how this destroys accounts. A trader enters a long setup on the USD 1 hour during his defined window. The setup is clean. Pivotal point confirmed. Position sized correctly at 0.5% risk. Stop loss is 20 pips below entry. Everything is textbook. After 3 1-hour candles, price touches the stop. He's down $60. This is his stop loss. This is where the trade ends. But instead of closing, he thinks, if I close now, I'm locked into a loss. If I move the stop down a bit, I'll give it more room to bounce back. So he moves his stop down another 15 pips. I'll give it room, he tells himself. Price doesn't bounce back. It continues lower, another 18 pips down. Now he's down $150 instead of $60. He's furious at himself. He's panicking. He closes at the absolute worst point, right before price bounces back up. But he doesn't know that. All he knows is that he's lost $150, and the trade is finished. That $60 loss became a $150 loss because he negotiated with the market, because he didn't trust his stop loss, because he let emotion override discipline. Now,
flip side of the same coin, and it's equally destructive but in the opposite direction.
Same trader, different trade. He enters long on another pivotal point, same setup quality, same position size, same discipline on entry. This time price moves in his favor. After 6 candles, price is up 38 pips. His target is 40 pips. He's almost there. And he's thinking, I'm so close to target. Let me just take the profit and lock it in. So he closes the position at plus 38 pips. He made money. He should be happy, right? But the trade keeps running. By the end of the day, it closes at plus 65 pips. He left $27 on the table because he didn't trust his setup, because he was afraid the profit would disappear, because he cut the winner early. Now let's look at the compound effect over time. In the first trade, he took a $60 loss and then negotiated it into a $150 loss. In the second trade, he took a $380 profit and then cut it at plus $380 instead of letting it run to plus $650. The difference between these two behaviors is $370. Over a month, if this pattern repeats even 5 times, that's $1,850 in lost opportunity and unnecessary losses. Over a year, it's tens of thousands of dollars. That's not market underperformance. That's self-sabotage. The maxim that encodes this entire principle is simple and non-negotiable. Stop losses are management. Targets are suggestions. Your stop is non-negotiable law. Your target is a minimum, not a ceiling. This asymmetry is what separates professionals from amateurs. Professionals treat stops like gravity. They're inescapable. Price touches the stop, the position closes. Gravity doesn't care about your hopes. Gravity doesn't care about your conviction. It just pulls. The stop loss works the same. It's the rule that protects you when you're wrong. But targets are different. A target is where you expect to get out if the trade performs perfectly. But trades often perform better than expected. So you should stay in. Let the winner run. Let price decide where the exit is, not your preset target. This doesn't mean you hold forever. It means you hold until one of 2 things happens. Either your profit target hits and you take it, or the setup breaks and you exit. Whichever comes first. But if the target hits and the setup is still intact, you consider staying in. You let the market pull you higher. This requires a specific mindset. You have to see your target not as a goal but as a minimum. It's the least you should accept from this setup if everything goes right. But everything often goes better than right. Markets trend. Winners compound. If you cut at the target, you're capping your upside. Professionals don't cap their upside. They cap their downside with stops and let their upside run free. Here's a real-world example from 2024. A trader I know was trading the ES 1 hour during the NYC open window. He had a setup that showed a clean pivotal point bounce off 4,850. His stop was at 4,835, which is 15 pips, a tight stop. His initial target was 4,880, which is 30 pips, a 2-1 risk-reward ratio. Good setup. He entered at 4,865. After 4 hours, price hit his target at 4,880. He made $300, 15 contracts x $2 per point x 10 points of expected move. But here's what actually happened. The setup was still intact. The candles were still showing strength. So instead of taking the full $300, he held. Price kept going. By day's end, it closed at 4,920. He ended up with a $1,100 profit instead of a $300 profit. Same setup, same entry, same stop loss, different exit discipline. He let the winner run instead of cutting it at target. That extra $800 is the differ. Hence between a mediocre month and a profitable month. It's the difference between accounts that grow and accounts that stagnate. And it comes down to one decision, treating the target as a suggestion, not a ceiling. Now, the psychological challenge here is real. When you're up $300 on a trade, there's real fear that it'll disappear. Your brain screams, lock it in, you've already won, don't. Be greedy. This fear is loss aversion working in reverse. You've gained $300 and you're terrified of losing it, so you lock it in. But that $300 gain becomes a $1,100 gain if you trust the setup and let it run. The fear costs you $800. The solution is to separate the exit decision from the profit-taking impulse. You don't exit because you've made enough money. You exit because the setup is broken, or because price has hit the target, and the setup is no longer showing strength. That's discipline. That's professional behavior. For your stop losses, the rule is absolute. Hit it and exit. No exceptions, no moving it, no hoping. The stop is where you've decided the setup is wrong. When price proves you wrong, you accept it and move on. For your targets, the rule is different. Hit it and evaluate. If the setup is still showing strength, stay in. If the setup is breaking, exit. This asymmetry, rigid on stops, flexible on targets, compounds into a profitable trading life. Here's what this looks like over time. You take 20 trades, 10 of them lose. You hit your stop loss on all 10, losing $50 each. Total loss $500. 10 of them win. On 5 of them, you cut at target and make $100 each. On the other 5, you let them run and make $250 each. Total profit, $500 plus $1,250 equal to $1,750. Net profit, $1,250. Your win rate is 50%. Your average loser is $50. Your average winner is $175. That asymmetry is everything. Now, if you'd held all the losers and cut all the winners early, you'd have had 10 lose. RS at $150 each, because moving the stop, and 10 winners at $100 each. Total loss, $1,500. Total profit, $1,000. Net loss, $500. Same 50% win rate, same number of trades, opposite outcome. The behavior killed you. This is why professionals obsess over stops and targets, not because it's exciting, not because it's clever, but because it's the mechanical framework that compounds small edges into large profits. Stop losses are management. Targets are suggestions. Live this and your trading life changes. This is where it all falls apart for most traders. They follow steps 1 to 4 perfectly for 3 weeks. Then they have 2 losing days. Then they abandon the system. They're done. They're convinced the approach doesn't work. They move on to something else. Why? Because they confused process with results. And in trading, results are noise. Process is signal. Results are what the market gives you on any given day. Process is what you control. A professional understands this distinction at a bone-deep level. An amateur doesn't. and that's why one survives and the other disappears. A professional takes a trade, follows every single rule, owns the window, identifies the pivotal point, sizes correctly, respects the stop loss. Everything is executed perfectly. Then the trade hits the stop loss. He's down $60, and he thinks, I executed correctly. The market said no. Moving on to the next setup, that's process thinking. He's evaluating his behavior, not the outcome. An amateur takes the same trade, does everything identically, hits the same stop loss, loses the same $60, and he thinks, I lost. The system failed. This approach doesn't work. Let me try something else. That's outcome thinking. And it's lethal because it causes him to abandon good systems before they've had time to compound. Here's the brutal reality that separates professionals from everyone else. Your system will be losing days, not just losing trades, losing days. Days where you follow every rule perfectly and still walk away down $300. Professional traders have win rates between 45% and 65%. That means they lose regularly. They lose roughly every other day, or worse. The difference between a professional and an amateur isn't that the professional wins more, it's that the professional loses smaller and wins medium to large. The asymmetry compounds into profit. Let me give you a concrete example, because this is where understanding becomes belief. I know a trader who committed to his 1-hour ES system for 2 years straight. 2 full years. No deviations. No system changes. No, maybe I should try day trading instead. Just the system. His window was 9:30 a.m. to 11:30 a.m. EST. His setups were pivotal points on the 1 hour. His sizing was 0.5% risk. His stops were hit immediately. His targets were suggestions. 2 years. Over that period, he took 200 trades. His win rate was 52%. That's barely above 50%. That's not impressive on the surface. But here's where the magic happened. His average winner was $240. His average loser was $90. Do the math. 104 winners x $240. 96 losers x $90. Equal to $24,960. $8,640 equal to $16,320 profit per year. Over 2 years, $30,000 plus. His win rate was barely above 50%, but his edge compounded because of the asymmetry, because of the process. Now, if he'd done what most traders do, abandoned the system after a 2-day losing streak, he would have made zero, less than zero. He would have been jumping from system to system, never giving any of them time to show their edge. He would have been outcome-focused instead of process-focused, and he would have been broke. This is why the final step is the most important. It's not mechanical like the others. It's psychological. It's about reframing what success actually means. For most people, success in trading means making. Negotiable process is the only thing you control. Outcomes are a side effect of good process. Own the process. Ignore the outcome. This is the statement that separates traders who build careers from traders who have a bad month and quit. You own the process. You execute it consistently. You refine it based on data, not feelings. You ignore the outcome because the outcome will take care of itself if the process is sound. You've now learned the 5 steps professionals use to turn the 1-hour chart into a consistency machine. Own your window. Recognize pivotal points. Size small. Cut losses fast. Ride winners without guilt. But the real test isn't understanding these steps. It's living them when the market tests you. And it will test you. It will have a 2-week losing streak. It will have a day where you follow every rule and still lose $500. It will have a setup that looks perfect and fails anyway. These are not signs that the system is broken. These are tests of whether you're committed to process or enslaved by outcome. The traders who survive and thrive are the ones who look at a losing day and ask, did I execute the process? If yes, they feel satisfied. If no, they identify where they deviated and commit to tighter execution. They don't look at a losing day and ask, did I make money? Because that question leads to desperation, system hopping, and eventually ruin. In the next video, we'll dive deep into how professionals think during drawdowns, the psychological architecture that separates traders who survive from traders who disappear. You'll learn the mental frameworks that let traders stay calm when the market is testing them. You'll learn the identity shifts required to see yourself as a process executor, not a moneymaker. You'll learn how to build psychological resilience that compounds over decades. Until then, commit to your process. Write down your 5 steps, pin them above your monitor. Make them your trading identity, because identity is what you'll fall back on when emotion tries to hijack your decisions. Your identity will save you. Your identity will make you rich.